ICICI Prudential Life Insurance reported a net profit of rupees 156 crore in the first quarter of FY23 compared to a loss of 186 crores in the year ago period, aided by significantly lower claims and provisions due to COVID-19. Value of new business increased by 32% to rupees 471 crores in Q1 FY23 compared to rupees 350 crores in the year ago period. Annual premium equivalent of the insurer stood at rupees 1520 crores in the reporting period. VNB margin of IPRU was 31% compared to 28% in FY20. To talk more about the company's Q1 earnings, we have with us Mr. N.S. Kannan, Managing Director and Chief Executive Officer of ICICI Prudential. Welcome to the
Thank you, Subrata. Thank you for having me on this.
In the past, you have mentioned that you want to double the VNB margin growth. In this quarter, VNB 31.
Past stakeholders is to double our absolute value of VNB of financial year 2019 in 4 years' time. So we have, as you rightly said in your opening remarks, we have grown our VNB during this period by 32%. So given that our target is about 22.5%, we believe that we have made a good beginning towards this journey. So to answer your question, are we confident of achieving what we have set out to achieve? Yes, we are quite confident. The beginning has been good and the levers are in place. So we think we should be able to achieve the doubling of FY19 VNB. The way we view the margins is really as a derivative. We focus on the absolute VNB, and depending on the APE development and the product mix development, whatever turns out as the margin, we take that. And you're right that the VNB margin has also expanded during this period to 31%. At this stage, we do believe that it is sustainable, this kind of VNB margins. But as I said, our primary objective is going to be VNB and margin is going to be the derivative.
Is protection business driving the VNB margin expansion? If so, what is the ideal product mix you're looking at?
Yeah, so if I look at our quarterly numbers by way of product mix, you would observe that 2 lines of business have done quite well. One is protection has grown at about 22%, because of which the protection mix as a percentage of the Q1 product mix is about 22%. Similarly, if I look at annuity, that has grown at 70% year on year. And annuity has become about 6.5% of our product mix from an APE perspective. So these two, from our perspective, are higher margin businesses. And also the opportunity in terms of under-penetration is quite acute. From under-penetration, it is very acute. From the opportunity perspective, it is enormous in these 2 segments. And from the margin perspective, the good news is that both these segments have much higher margin compared to the organization's average margin.
What is the ideal product mix you're looking at, sir?
So from the, we don't have a target, Subrata, in terms of this is what the product mix we want to achieve. But directionally, if you look at, to answer your question, just to give a color on that, I believe that the protection has an ability to be between 20 to 25% in the long run. I say that because of the pandemic partly, and because of the general under-penetration, this is a segment which will have a lot of tailwind in terms of demand. And as you know, we have had some challenges in terms of the supply side in not being able to fulfill, just not as a company, just as an industry, I would say, not being able to fulfill the demand in the short period, in the short term, because of the pandemic-driven environment. Currently, what has been driving the protection growth for us is more of a credit life and group businesses, not so much on retail businesses. But once things settle down on the retail side, I think retail protection also will be a great opportunity. Between ULIP and a non-linked business, that could depend on the market conditions. Sometimes customer preferences towards guaranteed products. Sometimes they like market-linked products, depending on the market environment. But we are quite indifferent to push either this or that, depending on the customer convenience and customer preferences.
Now, retail product protection segment continues to lag while group protection has done really well. What are the reasons for the underperformance of the retail protection business? Is it because of the supply side constraint that we saw during the pandemic?
Yeah, I'll quickly get the group side out of the way. As you rightly mentioned, group has done well. You're absolutely right that what has got somewhat impacted is the retail protection business. I still feel that it is more of supply side constraints, like you are mentioning. Why I say that is because the demand side, we are not seeing any lack of demand. In fact, I would say that the pandemic has made this product from being a push product to a nudge product. In the sense, people want to be insured more. Even if we look at the persistency as a proxy, persistency is improving today post the pandemic situation, because people want to make sure that they are well covered by paying the renewal premiums. So given all those indications, I think demand is quite intact. Supply side constraints have been there. You asked why those supply side constraints. I think it started off with the lockdown, and around that time, we were not able to send the prospective customers for medical examinations. So I think that constraint initially started off in that manner. And then subsequently, companies like us, as well as our own reinsurers, they started tightening the underwriting standards, because when the live pandemic is on, you just wanted to make sure that when you're writing a 40-year, 50-year product, you want to be clear about the underwriting standards. These 2-3 issues led to supply side constraints. I'm not saying now that we are completely out of the supply side constraints. So it's more of a supply side constraint, yes, but slowly it will get better as we are at the tail end of the pandemic, plus some of these processes stabilize on the ground. I think by Q3, we can see a year-on-year growth.
So are you also looking to relax some of the underwriting standards that were tightened during the pandemic?
I don't think wholesale relaxation will happen, but we'll keep looking at the data and see if there are certain types of customers or customer segments where our experience is better based on certain proxies. When we look at, then maybe we can look at it at the margin. Some of these segments we can look at based on, because we do have a large portfolio now, and we do have a little bit of short-term post-COVID experience also. So we could look at it and then tweak it at the margin, I would say. But as you all know, the long-term impact of COVID is still not understood. So I have a feeling that it will take a long time before it gets completely relaxed. But in the interim, we'll be focusing on some tweaking, looking at some desirable customer profiles, relaxing it somewhat. But certain other areas, it may continue as it is. But what has happened, I can tell you, is that the frequent change of processes is behind us, is what I feel. I think it's more of stabilization of the process, but relaxation will take a longer time, is what I would say.
Now, with the interest rate cycle turning and the rate hikes happening, do you think the guaranteed products, the demand for guaranteed products will suffer, and we will see an increasing demand for non-par products?
Yeah, so the way I look at it is that the guaranteed products are chosen by customers at times of uncertainty. So they want some certainty in terms of their savings and the returns from the savings, and that has been the key driver of guaranteed products in the industry. Now, your question is around the interest rate cycle reversal. When the interest rates start going up, some of the other competing products like bank deposits eventually may also see an increase in rates. So now at that time, it is possible that the relative attractiveness of the guaranteed products of the life insurance industry may be somewhat different from what it is currently. So at that time, maybe there is a little bit of demand shift towards the other sectors of the financial services rather than guaranteed products of life insurance. But at the same time, you should also see that at that time, when the overall interest rates goes up, the guaranteed products rates also potentially could go up, because we are able to invest and gain more return. So my sense is that at the margin, it could get impacted. But the good thing about life insurance industry is that we do have other products in the non-linked space as well, like a participating product, which also partly invest in equity. So you may be able to get a better return on a smoothened basis in that product also. So yes, between participating products, non-participating products, and linked products, the demand may shift from one segment to another as the interest rate cycle reverses, as the equity markets become more stable. But that is something we are prepared for, and one has to be careful about the demand shifting from one to another. As long as a company we are prepared to sell all the 3 lines of business, we are quite okay.
In the January quarter, especially, you said that you increased the retention on your books as far as retail protection is concerned, and the limit was increased to around 1 crore. Was it because of the frequent rate hikes that the insurers were taking? And does it not put the company's balance sheet at risk in case there are events like COVID happening again?
Yeah, in the retail protection, Subrata, I'll talk about 2 lines of business. The first line of business is a pure retail term, and the second is the return of premium product, which we introduced in the 4th quarter. And that is broadly about 18% of our protection portfolio today. So in this product, the return of premium, the retention is 4 million rupees. That's 40 lakhs. I just wanted to say that 1 crore, we have not done it because it's early days. The return of premium is recently launched. We thought we should observe the experience before we take up the retention. If you look at the retail term, pure retail term, you're right that we increase the retention to 1 crore. The logic for doing that was that when we looked at certain desired profiles of customers, and we have a long record, and we were one of the pioneers in retail protection, we have a large portfolio. When we looked at that in the desirable segments, the experience, our own actual experience of mortality was such that we would have paid too much if we agreed for reinsurance. So the reinsurer's experience in that portfolio versus our own experience was in favor of retaining more because we had a better risk outcome. And we didn't want to split the profit with the reinsurers in respect of that portfolio. That has been the logic behind this. And largely we look at reinsurance as a capital relief. And when you are at a 204%, 205% solvency ratio, there's no need at this stage to too much optimize the capital needs. So these are the two drivers behind the retention decision. We are continuously monitoring it. To answer your question, it's a little bit too early days because, as you rightly said, we have just done it in a couple of quarters in terms of retention, but we'll keep evaluating it.
What will be the company's target when it comes to VNB margins post FY23?
We will grow the VNB in line with the industry growth of VNB. We have not given any specific target to say we will double it in 4 years or anything like we have done in the past. But we believe that at this stage of the company, now that product mix is well diversified.
Thank you so much for answering our questions, sir. Thank you for joining us on the Business Channel.
Thank you, Subrata. Thanks for this opportunity, and best wishes to you and all your readers. Thanks.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
I am the blue of the limitless sky. I am the inspiration that led success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.